To understand Rifco, you have to go back to 1969, to the trading pits of Chicago. A commodities trader named Raymond E. Friedman founded Ray E. Friedman and Company, Rifco for short. It was a small futures brokerage focused on cattle, grain, and livestock. The kind of place where deals were shouted across a pit and confirmed with a nod. Friedman was joined by a young trader named Thomas H. Dittmer, who quickly took over and turned Rifco into an aggressive, hard-charging futures powerhouse. Through the 1970s and 1980s, Rifco grew into one of the dominant names in commodity trading. Then in 1998, a British-born accountant named Philip Bennett became CEO. Bennett was the opposite of the Chicago pit stereotype. Quiet, meticulous, buttoned up. He had joined the firm in 1981 as a treasurer and worked his way to the top over 17 years. Under Bennett, Rifco expanded beyond commodities into foreign exchange, bonds, and derivatives. By 2004, it was clearing hundreds of billions of dollars in trades every month. Then came the deal that would ultimately expose everything. In August 2004, Thomas H. Lee Partners, one of the largest and most respected private equity firms in the world, bought a 57% stake in Rifco for $507 million. Thomas H. Lee's team did months of due diligence. Lawyers, accountants, forensic analysts, they pored over the books, and they saw a healthy, growing, profitable business. Or so they thought, because sitting quietly in Rifco's balance sheet was a black hole. A hidden pit of $430 million in bad debt. If this is gripping you, save this video. You will want to come back to this one because the mechanics of what happens next are stunning. Every 3 months, that black hole would appear on the books, and every 3 months, Philip Bennett would make it disappear. But that trick was about to stop working. Here is where the story turns. In the late 1990s, some of Rifco's biggest clients had lost enormous sums trading Asian currencies and Russian bonds. They could not pay their debts back to Rifco. Under normal accounting, Rifco should have written those losses off. They should have been recorded as bad debts, and the loss would have hit Rifco's earnings hard. Instead, Philip Bennett did something else. He moved the bad debt. He transferred those uncollectible customer losses to a private entity he controlled, called Rifco Group Holdings Incorporated, RGHI. On paper, it looked like RGHI now owed Rifco $430 million. That receivable was a real asset. It made the books look clean. But there was a problem. RGHI was Bennett's own vehicle. It had no way to actually pay back $430 million. And every quarter, when auditors came around, they would notice this huge related party loan sitting on the balance sheet. That would raise red flags. So Bennett engineered a solution, one of the most audacious accounting tricks in modern American history. A few days before the end of each financial quarter, Rifco would loan hundreds of millions of dollars to an outside hedge fund called Liberty Corner Capital Strategies, run by a New Jersey money manager named William Sexton. Liberty Corner would then loan that same money to RGHI. RGHI would use it to pay off the debt to Rifco temporarily. So on the reporting date, the balance sheet showed no related party debt. It showed a clean loan to an independent third party. Days later, after the audit snapshot was over, the money would flow back the other way. Liberty Corner would repay Rifco. RGHI would owe Rifco again. And the $430 million hole would reappear invisible until the next quarter when the same shell game would run again. This was called round tripping, and Bennett did it for at least 7 years. Through it all, no auditor caught it. Not the internal team, not Grant Thornton, the outside firm, and critically not Thomas H. Lee Partners' due diligence squad in 2004. They wrote a check for $507 million for a company whose CEO was quietly hiding a $430 million liability. And now Bennett was going to try to sell the company to the public, while the trick was still running. Which brings us to August 2005. That is when everything started to break. On August 11, 2005, Rifco went public on the New York Stock Exchange under the ticker RFX. The IPO priced at $22 a share. On its first day of trading, it jumped 27%. It became one of the most successful public offerings of the year, raising $583 million. Thomas H. Lee Partners saw their investment double. Philip Bennett personally cashed out more than $100 million in stock. Wall Street cheered. But behind the scenes, the fraud was becoming impossible to hide. The problem was that being a public company meant new levels of scrutiny, quarterly filings, Sarbanes-Oxley certifications, independent audit committees. In early October 2005, a Rifco internal accountant going through routine records noticed something strange. A $430 million receivable owed by an entity nobody could identify. She flagged it. Word climbed the chain. On October 10, 2005, Just 60 days after the triumphant IPO, Rifco issued a bombshell statement. The company announced that its CEO, Philip Bennett, had hidden approximately $430 million in uncollectible debts owed to the company. Bennett had wired $430 million to Rifco that morning, personally, to try to make the receivable disappear one last time. It did not work. The board suspended him within hours. 2 days later, on October 12, 2005, federal prosecutors arrested Philip Bennett. He was charged with securities fraud. The stock collapsed from $28 a share to under $1 in a matter of days. On October 13, Rifco suspended trading in its main brokerage unit. Customers panicked. Withdrawals surged. Rifco could not meet redemption requests. On October 17, 2005, just 68 days after ringing the opening bell at the New York Stock Exchange, Rifco filed for Chapter 11 bankruptcy. It was, at the time, one of the fastest collapses of a major public company in United States history. Thomas H. Lee Partners lost most of the $507 million they had invested. IPO shareholders lost billions. Customers found their trading accounts frozen. And a firm with roots going back to the 1960s was gone. But that was only the beginning, because now the investigation started, and what came out next was even worse. As bankruptcy examiners dug through the wreckage, they uncovered something that changed the entire scandal. This was not one man acting alone. Prosecutors eventually charged multiple executives, including Rifco's president Santo Maggio and chief financial officer Robert Trost. Both would plead guilty. Lawyers at the law firm Mayer Brown, who had helped structure the loan transactions, would be sued for hundreds of millions. Grant Thornton, Rifco's auditor, would face years of lawsuits from angry investors. Investment banks including Credit Suisse, Goldman Sachs, and Bank of America, who underwrote the IPO, would collectively pay hundreds of millions of dollars in settlements to Rifco investors. In 2008, Philip Bennett pleaded guilty to 20 counts including conspiracy, securities fraud, wire fraud, and money laundering. A federal judge sentenced him to 16 years in prison. He would not be released until 2021. And here is the twist nobody saw coming, the one that reframes the whole story. Bennett's trick was almost identical to a scam pulled 42 years earlier. In 1963, a New Jersey commodities dealer named Tino De Angelis engineered what became known as the Great Salad Oil Swindle. He borrowed $175 million against warehouse tanks he claimed were full of soybean oil. In reality, most of the tanks contained water, with a thin layer of oil floating on top to fool the inspectors. When it collapsed, it took down 51 companies, including Ira Haupt & Company, and cost American Express nearly $60 million. Different assets, different era, same trick. Hide a real hole using a fake asset that only appears real when someone looks at it. What Rifco proves is that Wall Street's oldest fraud, inflating one thing to hide another, never actually goes away. It just puts on a nicer suit. Bennett was not a rogue trader. He was a chartered accountant. He wore quiet ties. He answered his phone politely. He built one of the biggest brokerages in the world, and he ran a shell game for nearly a decade under the noses of the smartest financial minds in the country. The lesson from Rifco is not that fraud exists. It is that even the most sophisticated due diligence, armies of accountants, top law firms, elite private equity investors, IPO underwriters, can miss a fraud if the fraud is patient enough and the CEO is calm enough. Trust is a system, and systems can be gamed by the person running them. CTA 1213 Min. If stories like this fascinate you, the collapses, the frauds, the deals that changed everything, subscribe and hit the bell icon. Every week, a new true money story. The kind of stories they should teach in business school but never do. And drop this in the comments. If you had been a Rifco investor in August 2005, would you have seen the warning signs? Or would 27% on day one have been enough to buy in? I read every comment. Outro 1315 Min. The Rifco collapse changed regulation. It accelerated tighter oversight of related party transactions. It made auditors more paranoid about quarter-end round-tripping. And it became a case study taught in every forensic accounting program in the country. But the deeper legacy is uncomfortable. Philip Bennett's fraud worked because he understood something that most white-collar criminals never grasp. Do not steal on the days people are watching. Steal on all the other days and put the money back for the day they check. Every quarter for years, the money went out. Every quarter for years, the money came back. Until one final quarter when it did not. Rifco reminds us that empires do not always fall to competitors. Sometimes they fall to a spreadsheet, a wire transfer, and a lie that runs 3 years too long. If this one hit, my next video is on Bernie Ebbers and the WorldCom collapse, an $11 billion accounting fraud that made Rifco look small. That story will stun you. Until then, stay curious about the money. In August 2005, Rifco was the largest independent futures broker in America. It went public in one of the hottest IPOs of the year. Just 60 days later, it was in bankruptcy court, and its CEO was in handcuffs. This is the story of Philip Bennett, the quiet British accountant who hid $430 million in bad debts from Wall Street's smartest bankers, auditors, and private equity firms, including Thomas H. Lee Partners, which had bought a majority stake for $507 million in 2004. From the trading pits of 1969 Chicago, when Ray Friedman founded the firm, to the shocking collapse of October 2005, this is how one of the most audacious accounting frauds in modern American history was built, hidden, and finally exposed. Learn how the round-tripping loans through Liberty Corner Capital strategies worked, why the fraud echoed the 1963 Great Salad Oil swindle by Tino De Angelis, and how Bennett ended up with a 16-year federal prison sentence. 0000, the $430 million collapse. 0030, the Rifco empire begins. 0300, how Bennett hid the money. 0600, 60 days from IPO to bankruptcy. 0900, aftermath and the salad oil twist. 1200, subscribe for more money stories. 1300, the legacy of Rifco.